Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of corporations. Today we're diving into a report about a fund that bets against regional banks. It's like watching a financial horror movie, but with spreadsheets. This report covers the first 6 months of this fund's fiscal year, ending in February. Think of it as a mid-year checkup to see how well this fund is doing at its job, betting against regional banks. Before we dive in, if you're into getting these insights from corporate documents, hit subscribe. Also, there is a Discord channel in the description. Join in and let me know what you think. First, let's establish what we're looking at. This is Form N-CSRS, a certified shareholder report for registered management investment companies. In plain English, it's a report that investment companies file twice a year to keep their investors informed. It gives people who invested their money a clear picture of how things are going. This particular report is for the period of September of last year to February of this year. The fund we're looking at is called the Total Capital Daily 2X Inverse Regional Banks ETF. Its ticker symbol is SKRE. The ticker symbol is like the short name for the fund, and you can find it on the Nasdaq stock market. The point of this fund is to perform 2 times the inverse of the daily performance of regional banks. Inverse is just the opposite. Christo if she designed for short-term bets, not long-term investments. This report contains information about the daily performance of regional banks. Inverse is just the opposite. TIDSO for short-term bets, not long-term investments. This report contains information about the Nasdaq stock market. The point of this fund is to perform 2 times the inverse of the daily performance of regional banks. Now let's see how much this thing actually costs. So what would the fund cost for the period based on a hypothetical 10,000? If you invested $10,000, the cost would be $33. This is the cost paid as a percentage of a $10,000 investment. The expense ratio is 0.75%. In other words, for every 100B going through how to the fund to $0, $10,000 investment, the expense ratio is annualized, meaning that they took a half-year cost and made it into a full year. Now let's look at the fund's holdings. Total return swap contracts make up negative 200%. Wait, what? It means the fund is using a type of derivative called a swap to effectively short the regional banking sector. It's like they are doubly betting that regional banks will go down. The fund's portfolio composition shows cash makes up about 90% of its holdings. The derivatives make up 9% and other assets make up the remaining little bit. So it is sitting on a large pile of cash ready to deploy, probably to meet redemptions when investors pull their money out. Okay, let's get to the numbers that really matter. As of February, the fund's net assets were about $4.2 million. It also has 2 holdings. Total advisory fees paid came out to about $17,008 for the turnover rate was 0%. That last one just means they didn't do a lot of buying and selling during the period. No significant changes. Now we switch over to the financial statements. Keep in mind that these numbers are unaudited, meaning that they haven't been checked by an independent accounting firm. The fund says its other assets net of liabilities are just shy of $4.2 million. Here, the fund breaks down its swap contracts, which are agreements to exchange one stream of cash flows for another, with a couple different companies, CF Secured and Clear Street Derivatives. A lot of the details are about how those swaps are structured, including when they terminate or end. Total notional amount or total face value of these swap contracts is about $844 million. Unrealized appreciation, which is basically profit that hasn't been cashed in yet, is about $38.4 million. Unrealized depreciation, which is basically profit that hasn't been cashed in yet, is about $38.4 million. Unrealized depreciation, which is basically profit that hasn't been cashed in yet, is about $38.4 million. Unrealized depreciation, which is basically profit that hasn't been cashed in yet, is about $38.4 million. Unrealized depreciation, which is basically profit that hasn't been cashed in yet, is about $39,000. The fund's assets include about $3.7 million in cash held as collateral is just money that you hold to make sure that you don't default. There's also about $123,000 in regular cash. Unrealized appreciation again is about $89,000 and due from counterparty on total return swap contracts. Due from the counterparty is 11Ds come in the form of accrued advisory fees, which are about $2,000 in regular cash. Unrealized appreciation again is about $38 9 Hessian dollars accreted dollar C fees, which are about 2,500 accrued $3,000 in regular cash. Unrealized appreciation again is about 38 olaties come in the form of accrued advisory fees, which are about $2,000 and due from counterparty on total return swap contracts. Due from the counterparty is $11,500. The fund's investment income was zeroed, but it had investment advisory fees, the money they paid someone else to manage the fund, of about $17,800. This leads to a net investment loss or loss after you take fees into account of negative $17,800. The fund took a net loss on the swaps themselves. The numbers here show for money coming into and going out of the fund from creation and redemption of shares. Shares issued means the fund created more shares and sold them for about $3 million back. The net effect of all these actions is that from this back and forth, the fund gained about $97,000. Combining the operations and capital stock transactions, the fund's net assets decreased or went down by about $1 million. 44 $8 million, $97,000. At combining the operations and capital stock transactions, the fund's net assets decreased or went down by about $1 million. The fund's net asset value NAV at the beginning of the period was about 16.91 cents per share. Net asset value just means the value of the fund after subtracting all the bills and liabilities. By the end of the period, it was down to 12.42 shin per share. This is a total return of negative 24%. The fund's expense ratio was 0.75%, and it had a negative net investment loss of 0.75%, and it had a negative net investment loss of 0.75%, and it had a negative net investment loss of 0.75%. So the expense ratio here has been annualized. In the notes to the financial statements, the fund lays out its reason for being, which is to seek 200% of the inverse or opposite of the daily performance of the SPDR S&P Regional Banking ETF. Remember that inverse means the opposite. The fund also tells us how it values its investments, which is at fair value. It means you are valuing your investments at the current market price. The fair value of the investments can be tricky though and requires judgment. If daily market quotes are not available, the board sets up methodologies to value them. The fund also uses a 3-level system for valuing its investments, with level 1 being the most straightforward. Level 1 includes quoted prices in active markets for identical securities. Level 2 includes other significant observable market-based inputs. Level 3 includes significant unobservable inputs. The fund accounts for security transactions on the trade date, which is the date the transaction took place, not necessarily when the money changes hands. The cost of securities sold is determined on specific identification basis. This helps them match costs with specific sales, especially for taxes. The fund says it intends to comply with the requirements of the Internal Revenue Code applicable to regulated investment companies and to distribute all of its taxable income to its shareholders. So the fund doesn't expect to pay income taxes itself. The fund creates and redeems shares only in large blocks of at least 10,000 shares, called creation units. Except when aggregated in these creation units, shares are not redeemable securities. This means that average investors can't directly buy or sell the shares with the fund. Instead, they have to trade on the secondary market. The fund uses total return swaps. Basically, they can be used as substitutes for owning the underlying asset, or as a way to get exposure to markets where the asset is unavailable. Total return swaps allow the fund to gain exposure to a market or sector index in a more economical way. If the counterparty to a swap agreement defaults, the fund's risk of loss consists of the net amount of payments that the fund is contractually entitled to receive. The fund's officers and trustees are protected against certain liabilities arising out of the performance of their duties. This is known as indemnification. The fund's maximum exposure under these arrangements is unknown, but they expect the risk of loss to be low. Total Capital Management LLC is the fund's investment advisor. They are responsible for the day-to-day management of the fund's investments. In return for their services, the advisor receives an annual advisory fee calculated as a percentage of the fund's average daily net assets. It is about 0.75%. During the 6 months ended in February, there were no purchases or sales of long-term securities, or purchases or sales of in-kind transactions associated with creations and redemptions. The tax character of distributions paid during the 6 months show that 151,269 was paid from ordinary income. During the period, the fund sold 220,000 shares and redeemed 190,000 shares for a net increase of 30,000 shares. An investment in the fund entails risk. The fund may not achieve its leveraged investment objective, and there is a risk that you could lose all of your money invested. The fund is not a complete investment program, and it presents risks not traditionally associated with other mutual funds and ETFs. After the period, in April, the United States announced its plan to implement worldwide tariffs. This event has caused a macroeconomic shock to the world economy and a significant increase in uncertainty in the equity markets. Lastly, we have supplemental information including remuneration paid to trustees and officers. The investment advisor covers all operating expenses of the fund. Therefore, what do we make of all this? The fund is betting heavily against regional banks using swaps. Its portfolio is mostly cash, which gives it flexibility, but also suggests it hasn't found many attractive investments. The fund's value decreased during the period, but that's to be expected with its investment strategy. The risk factors highlight the potential for losses, especially given the fund's leveraged approach. The fund has to contend with possible tariffs from the US. Overall, this fund is a high-risk, high-reward play on the potential downfall of regional banks. It's not for the faint of heart, and it requires a strong belief that those banks are headed for trouble. Alright, that's our breakdown of this SEC filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.